Hey guys, I'm Rick Mount, and we're excited to spend some time with you today talking about the state of the housing market. I'm joined here with my partner, Mike Hardy. Collectively, he and I co-manage Pacific Southwest region for Churchill Mortgage, and we're here with our team manager, Kevin Sprague. There's a lot of emotion out there in the marketplace today. Rising inflation, rising interest rates, affordability, a lot of noise, a lot of emotion. We thought today we would help separate facts from feelings and share some data and some underlying information on the similarities and differences between 2006, 2007, and today. So many questions out there about, is this another crash? Is there a bubble? And so we thought we'd talk a little bit about the psychology of the worries of the housing bubble. And 77% of consumers think that there's going to be a bubble, that there's a housing bubble that still persists. And maybe even more importantly, 44% of real estate agents believe that there is a worry of a housing bubble. The problem with worry is it's based in fear, and people behave differently with fear. So we're going to unpack some information today around homeownership and data that will help hopefully educate you so that you can make a healthy decision on wherever you are at in that process. So Mike, I'm going to turn it over to you.
Sounds good. So guys, today's topic is going to be on, it's called Facts Not Feelings. And we're going to look at the similarities and differences between 2006 and 7, leading to 7, 8, and 9, and then where we are today in 2022. And I want to start this conversation. It's going to be a fun conversation, but I want to start this by sharing something personal. And I grew up, I remember growing up and we didn't really have any money at all. We grew up in a mobile home, and me and my two younger sisters lived in one end. Then we had this little kitchen area and hallway, and my living area, and my folks in the other end. And long story short, I remember when we bought our first home, like the world just opened up to have my own room and to think clearly and to see the world differently. And just, I think there's something that is super important about having healthy families and healthy homes. And so part of our conversation is not just going to be about the math, but we always want to understand here at Churchill, why are we doing what we're doing? Okay, and we want to make the world a better place, and that starts with healthy families. So there's a saying which is, one new idea or one new relationship can completely change the trajectory of your life. Okay, and so ideally we want each of you to have one new idea today that is something that can be life-changing. Okay, so we all have the world that we know, and then we have the world that we know that we don't know, and then there's this entire world that we don't know. And that's the reason we call this facts, not feelings. A lot of times, like, our feelings can cause us to maybe play tricks on ourselves and not make healthy decisions. So we bring this up, guys, because we're going to unpack a lot of things. The very first one that we're going to start with is on interest rates. Kevin, over to you.
Thank you, Mike. Thank you, everyone, for joining us today. And one of the first things almost all of our clients that are going to buy a home right now are asking about is interest rates, for obvious reason. It's everywhere you look in the media. Interest rates are one of the first things coming up. And we have a couple charts here to show. This is the first one to the most recent 2 years, the history of the average 30-year fixed mortgage rate. Over the last couple years, you've probably seen interest rates have been at historic lows, below 3% in some cases, in the low threes. And recently, the last 6 months or so to start the year, interest rates have shot up pretty dramatically, pretty quickly. We've seen average interest rates above 5% for about a month or so now. This graph is actually outdated and it's only a few days old. That's how quick rates are moving right now, towards 6, high 5s, low 6s. Dramatic increases. So it's natural for a first-time home buyer to think, hey, we're at really, really high interest rates right now. The next chart we want to show is a little more perspective. This shows 50 years of history, and the spike that we're seeing is that very end of the chart that you see on the right-hand side. So this does not necessarily mean that buying a house is affordable right now, or it's the right time for you and your family. We'll talk about that later on in terms of affordability, but what this does show, interest rates below 5 or 6% are really the outlier when you look back 30, 40, 50 years. So just from a rate perspective, this perspective really gives our clients the knowledge to say, hey, wait a minute, rates are relatively high right now, but when we look back over 30, 50 years, we're still in a very low position from a rate perspective. So we'll unpack this more as we go, but we thought this was a good place to start because everybody's asking what the heck is going on with rates right now. So we'll talk more about that in a bit.
All right, guys, so this is a fascinating chart. As we look at what is going to happen in real estate, one of the very fundamental things that we want to look at is the basics of supply and demand. And so here, we're going to talk through some of the demand side. Okay, this is not something that's covered very often in the media, but it is very relevant to where values are now and where they're going. Okay, so this is an interesting chart. This is births underlying each generation. And you can see we've got the baby boomers, the X generation, the millennials, and the post-millennials, and you can see sort of the size and the, the flow, if you will, of folks of when specifically they're turning 33 years old. That's how this chart is set up to show. And why 33 years old? I'll tell you. Because average age for somebody to buy a home is 33 years old. It was true back in 2006, and it's true today. And so something very fascinating is, and again, we're looking at similarities and differences between the Great Recession and where we are today. Look at what's different today versus back in 2006. If you look at that first red arrow and the circle, you can see the X generation, there was a pretty dramatic drop-off of new buyers coming into the marketplace. All of a sudden, look at this, it happened right at the same years that real estate went down and went down significantly. It's one of a few factors, but it was an important one. Look at where we are today. You can see this red arrow and the blue arrow up. You can see the wave of new millennial buyers coming into the marketplace based on where we are. And you can see there's still a number of years of increasing new buyers coming in year after year after year. So we share this, guys, because it's important context. A lot of the things we do in this talk, we're going to look at from a 30,000 foot perspective to be able to step back and see what's the same and what's different. On this slide, you may be asking, what happened when was it? I guess it was 2006, when all of a sudden there was a drop off of 33-year-olds. Well, if you go back 33 years prior from 2006, that was 1973. As it turns out, there was a very prominent Supreme Court decision that took place in 1973, which was Roe versus Wade. And you can see, fast forward, what happened demographically, and there was obviously a significant reduction of new buyers because of that ruling, and you can see how that plays through into the marketplace. So something pretty fascinating that I don't know is very well known that we wanted to share with you as one of the differences.
Continuing that conversation on the demand side, right? When we look at supply versus demand, one thing that's really relevant is where are we now versus 2007 from a population and a household perspective. As you can see with this chart, we've had consistent increases in the number of households in the market now versus then. So if inventory levels were exactly the same as they were then, which we'll talk about in a minute, they're not, we would still have about 14 million more households in the U.S., which kind of follows that chart Mike just talked about. We expect this number to continue to increase looking at those demographic numbers. Now, the second part of this is supply, right? Demand is obviously higher now than it was leading into the crash. What about supply? So if we look at the next chart, there's a line that goes through this screen that's the rising U.S. population. The squiggly blue line are inventory levels. So you can see the run up in homes for sale from the early 2000s until the peak in 2008, where it's circled there on your screen. That is a rising amount of properties available for sale. Where we are today is on the far right, much, much lower than it was then, even though the population's much higher. So this is another way of illustrating, leading into the crash last time, we had huge inventory levels, huge supply, and a drop-off in demand that was coming, like Mike was talking about. Today, we have an increase in demand that has happened since then and is going to continue. And then supply levels, inventory levels are much, much lower. So this is one way of illustrating it. One more slide, this next one will show, comparing 07 to 10, months of inventory available versus the last 4 years, where you can see 3, 2, 1 month of inventory available in some cases versus 7, 8, 9, 10 back during the crash. So this, again, like Mike was saying, we're unpacking today what is the same and what is different. One huge difference is just in fundamental supply and demand. Much lower supply, much higher demand means, frankly, a much higher level of support for values. And then the next question becomes, when is this going to change? When are we going to have enough supply to keep up with the demand? So turn it back over to Mike for that.
Okay, looking at the next slide, guys. First of all, for some perspective, there's about 330 million folks in the United States, plus or minus. There's about 140 million residences. There's roughly 80 million single-family residences. I want to show you this chart because you can see that in order for us to keep up with population growth and household formation, we need to have a certain number of new builds coming into the marketplace. This chart is a great illustration to see the significant, huge drop-off of new builds that took place right after 2007. If you can go, you can see through the 8, 9, 10, 11, 12, 13 years, all of a sudden there was just this gap. So there was a dramatic undersupply that is just now showing itself in the marketplace, and it's one of the reasons there's been a dramatic run-up in home values recently. It's just been a drastic undersupply. As we look at this, there's somewhere in the range of 3 to 5 years from what we see of new builds that need to come into the marketplace to be able to get to a place where it's considered more of a healthy balance between the population and the homes available for the population. This is an undersupply issue, guys, that we're dealing with. Okay, so you may be asking, well, we keep hearing about foreclosures. In fact, if you notice headline after headline, in fact, this was a couple of weeks ago, you could see foreclosures surge in January after end of pandemic freeze. Okay, U.S. foreclosures are the highest since the pandemic start. And even the next slide, which shows wave of foreclosures may follow housing market boom. Guys, we want to show what's happening in the media and then what's really happening from a 30,000 foot perspective to bring some context to this, because so often we see these things and without knowing better, human nature is to get scared and do nothing and freeze, okay? So let's take a look at the foreclosure surge that's taken place on this next chart. Okay, so all of a sudden, if you look to the far right, you can see the surge that's taken place. And I want you to compare this. This chart goes all the way back through 2005. You can see the foreclosures that have, the run-up of foreclosures through the Great Recession, and then as it wound down and worked its way through the system. And then, of course, you can see the dramatic fall-off that took place. When was this? This was right during the pandemic. All of a sudden, there was the option for forbearance to take place. There was the option for forbearance. And so then all of a sudden now we had to have that start working through the system, and you can see the quote run up or surge that's taking place. So guys, the reason we show you this chart is that typically to run in the kind of 1 to 1.5% range for foreclosures, if I'm remembering correctly, is considered a normal pace. We're well below that. Right now we are only about 60% of where a usual run rate is for foreclosures, all things factored. But you may be saying, well, what about all of these properties that went into forbearance? We're going to look at that next.
Yeah, guys, let's talk about the loans and forbearance. So this next chart just shows you from the beginning of really when COVID hit and the forbearance option became real was back in May of 2020. So it was roughly just a little under 5 million households that engaged in forbearance. Interesting story, Mike and I have close friends. One anecdotal story here, one had 40 properties, the other one had 10 properties, and they were almost encouraged to go into forbearance by the servicers that would call them. Neither of them from a financial standpoint needed to, but not knowing what was going to be in front of us with the pandemic, they both opted to go into forbearance because they just didn't know. So as we look at how this is unwound and you go all the way to the right of the screen today, there's very few people left in forbearance. And so as we look at the effects of foreclosures on the past market and what could have been a looming foreclosure market here, most of the forbearance has already been worked out. And that leads over to another condition of the market that's radically different from then versus now.
Yeah, one big difference now that we get the question, hey, what makes you think more foreclosures aren't coming in big waves or that forbearance isn't going to cause huge issues for people? It really has to do with the equity in their homes. So a couple of these stats we thought were really relevant to share. In 2007, leading into the last crash, average equity in homes, including all properties that were paid off, all properties that were underwater, and everything in between, average equity was about 37%. Today, it's almost 70% nationwide average equity in homes. 95% of homes nationwide have at least 10% equity in their homes. So when we look out into the future over the next couple of years and say, is there going to be a wave of foreclosures that flood the market and drive down prices dramatically? A couple of these stats are really relevant to know. I mean, it's really hard to have a wave of foreclosures when you have a huge amount of equity nationwide. So this, along with the liquidity in the market, this is a huge difference now versus then of why we may predict a different result this time around.
And guys, as we go to this next chart, this is some perspective here. Again, a 30,000 foot perspective. We've got about 12 trillion of outstanding mortgage debt, and we've got about 33 total trillion of U.S. real estate value with a homeowner equity somewhere in the range of 20 trillion. And I share this, guys, because again, we're looking at similarities and differences. And for us, part of what's important is how do we best give guidance to our clients and partners about what's happening in the marketplace? There's a huge issue we're going to talk about in a minute, which is affordability. But what we want to cover first is what is different, and then we're going to cover what's the same. This equity piece is very different. As Kevin was just showing you before, if you go back to the Great Recession, 1 out of 4 people underwater. If you were to look next door, underwater, cross the street, free and clear, maybe on your other side it would have been sort of at the water line. It was just a complicated time. Now you have to go down the block, around the corner, and up the street to find a property. It's 1 out of 100 that's underwater. So it's very different. And why do we share this? We share this because we want to look at what is stable and what is not stable. In fact, we're going to get in now to what I think is really important, and then we're going to get into some of the key things that are affecting us today. So as we look at the next slide, all of you guys, I'm sure, have heard of The Big Short, if not seen the movie or read the book, The Big Short. One of the key individuals in that book is a gentleman by the name of Michael Burry. He's the founder of Scion Capital, and one of the early guys to the game to be able to understand the dysfunction that was taking place in the mortgage markets. Something very different from today. What does he say here? Home prices did not crash in 07 and 08 because they had climbed so high. Home prices crashed because, among other things, borrowers could not make the mortgage payments. Okay, why is that important today? Okay, we're going to move to this next slide, which is showing a huge difference in the product mix back prior to the Great Recession and then the product mix today. We have some of the, quote, cleanest and highest lending standards right now, and you can see that the product risk, what does that mean? That means that the red is really more adjustable rate mortgages, not to mention borrowers that shouldn't have had loans. I'm not even talking about that. I'm talking specifically about products. So there was roughly 40% of the marketplace was hybrid adjustable rate type mortgages where if interest rates adjusted, the payment would move up with it. So you can imagine as the Fed went through and had to increase interest rates during that window of time, again, separate conversation we'll get to in a minute, that was the key thing that pushed a huge percentage of the population into not affording a home and subsequently defaulting on their mortgage. Compared to today, about 1% of the population is in adjustable rate mortgages. The overwhelming majority are 30-year fixed and 15-year fixed. So nothing like the last time. We want to share that again more for like the what's happening below the surface. We'll get to some challenges in a minute, but with that, we'll go over to Kevin.
Yeah, to piggyback off that a little bit, the standards in the lending industry are much different this time around as well. And there's a few different ways to measure this, right? Like Mike was talking about, types of products that are available and readily being used. Another one is like, how about the worthiness of the borrowers, right? The credit score, the ability to show income to repay the loan. This is one chart. Credit score isn't everything, but this is a huge difference leading up to the crash last time versus now. In orange, you can see the 5 years preceding the crash. That's the amount of the dollar amount of mortgages with a credit score below 620. And in blue is everything since. You can see that number has trended downward. It's much, much lower now. And credit score doesn't tell the whole picture of whether we should lend to a borrower or not, but it's a good predictor of whether there's a large percentage that won't be able to pay it back in the future. So that's one chart. And then another one shows it in a similar way. The dark blue and the yellow on the left, those are lower credit scores. You can see the percentages of loans are higher there. The light blue is a really high credit score. So you can see the different tiers have shifted more towards higher credit scores more ability to repay the loan versus leading up to the crash last time when the products were riskier and frankly the profiles of the borrowers were riskier because there wasn't as much oversight and rules in the lending industry. So this is another huge difference now versus then. When people are talking about a crash coming again, these are the kind of similarities and differences we're explaining.
All right, so guys, let's get into something that's becoming a significant pain point. And I want to just share some context and some history here. If you look at home prices back in 2006, 248 was the median home price, and then you move to 2021, 370, and then up to today, 429. Interest rates, 6%, 2021, 3%. Today, we're actually well north of 5.5 now from when these slides were put together a couple days ago. So we're in the low sixes now. So the point is this, guys, the affordability is becoming an issue. Okay. Now, what we want to always make sure we look at it is affordability. How does that compare as a percentage of monthly income to go toward the mortgage payment? Because what we know is that rule of thumb for somebody to have a healthy mortgage payment somewhere in the 25, you usually don't want to go over roughly a third of income to go toward housing payment. Even sometimes programs will allow that to go higher, but just from being fiscally responsible and healthy budgeting, what we're seeing now is a lot of families, especially first-time buyers, they're starting to see themselves be priced out of the marketplace from an affordability issue. As we see a monthly payment move from, let's call it $1,190 up to roughly $2,000 now per month, what I also want to draw your attention to is hourly wages. Okay, this is something that is going to be trailing and catching up. Guys, right now, if you look at the job market, there's more jobs available than there's been, I think, in a century. Okay, so you're going to see a trailing increase of wages that will catch up. And also, I don't know that it keeps pace with inflation. I doubt it. But the point, guys, is that we have this gap right now as interest rates rise and home values rise. Affordability is a challenge. It will continue to be a challenge for a while. So we share this now because that's a similarity, but again, very different fundamentals under the surface. Okay, this next chart, guys, very similar. This is also showing sort of at the peak monthly payment for median new home as a percentage of median household income. You can see that we're starting to run up on a ceiling here. Now, here's what I want to stress. What this does is it causes folks to buy at a lower price point, and it slows the pace of growth. And as odd as this is to say, increasing interest rates is probably one of the healthiest things that could have happened to the housing market. Why? Because the runaway values that were taking place. Of course, to have interest rates in the 2s and 3s, the affordability was getting down to, I think it was even in the teens as a percentage of income. What's that going to happen? People make decisions typically based on cash flow budgets, whether it's owning a home or renting, and we can see what's happened in the past and where we are now.
Yeah, thanks, Mike. Inflation definitely has an impact, rising interest rates or an effect of inflation, but real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values. So let's talk about the effects of homeownership and a hedge against inflation. So if you're looking at this chart going back to the 70s, measuring each decade, 80s, 90s, 2000s, 2010s, all the way through today, 2021, you can see that real estate values have actually outpaced inflation in almost every one of the markets. If nothing else, they were sideways, with the exception of the 2010 decade, which included the great housing recession. And that's the only time in history where we've seen housing not do as well as inflation during that time frame. So as you can see, long-standing, most of the time, housing is going to be a great hedge against inflation.
Yep, and so guys, even with that chart prior, the point here is that real estate grows about a 4 to 5% trend line over the last 100 years, okay? And when there is windows of inflation, usually hard assets will move in tandem with inflation. As the opposite of cash, we'll get to that in a minute. I thought these were two interesting articles. One was by the Wall Street Journal, and it says, "A home is your castle against rising inflation." Pretty fascinating. It was a good article if you wanted to look it up. Elon Musk believes U.S. government has understated the true magnitude of inflation. I love listening to Elon and what he has to say also. So guys, the point here is with inflation, holding cash compared to real estate, That's what I want us to be thinking about, is real estate and hard assets will typically be a very, very good hedge. Okay, so now what's happening to the dollar? Let's look at the purchasing power of a dollar. And guys, if there is, let's just use the rule of 72 to keep it simple. Let's just say that inflation is 7% over a decade. What does that mean? That means that $100,000 will be cut in half from a purchasing power perspective. Let's use another example. We've seen right now, I mean, it's arguable that it's much higher if you look at shadow stats in some other areas, but if you look at inflation currently and it's showing, let's just round to 8% to make it simple, and you have $100,000 of cash, over the course of 1 year, you've turned $100,000 of cash into $92,000 of purchasing power, okay? Inflation is known as slow motion theft. And one of the things that real estate does is it provides a hedge against it. So we thought that would be some interesting perspective to share. And now we're going to go, this is a big question we're getting quite a bit, guys, is what about a recession? Are we in one? We're on the edge. We're hearing things. We're seeing things. We're starting to run negative. Okay, so this is a pretty fascinating chart. There's a saying which is, history doesn't necessarily repeat itself, but it certainly rhymes. And we want to show you a couple of things here. If we look back at the last 8 recessions that have taken place, there's been one recession where real estate actually dropped. All others, real estate moved either sideways or up through that recession. Why is that? Or what happened, I should say, in this last recession back in 2008? Well, it was a real estate crisis that caused the recession, okay? That's a key difference here. But we thought it would be good to show the last, 50 years or so, 50 years, and look at all the various recessions to see what has happened to real estate through the recession. I think this was some helpful information. And then let's get into what's happening right now with the Federal Reserve and look a little bit at history here too, because I want to show you the cycle that takes place. Okay, we live in a world of cycles. All right, if we look back to the Volcker era, and this is sort of, everyone talks about, those who have been in the business for many, many decades talk about how interest rates were, way up in the teens. Well, let's look at what happened. I mean, inflation is a primary driver of mortgage interest rates, okay? And if you look at inflation and you can see the run of 7% to 14%, you can see what happened to mortgage rates. They went from 12 to 18. And then what did the Fed do? The Fed increased the federal funds rate from 11%, is it 11 to 20%, okay? And then what happened to inflation? Inflation was tamed and it dropped from 14 to 5. It took an aggressive tightening by the Fed to get in front of inflation and bring it down. But what happened to mortgage rates? They dropped, okay? Mortgage rates dropped from 18 to 12%. And you can see similar thing happened with Greenspan. Likely similar thing will happen with Powell. We're going to have to get in front of inflation to tame interest rates. But typically, and if we go to this next slide right here, you can see what happens to interest rates during recessions. So guys, this is what we always want to do when we see dramatic spikes in things, is we want to take it into context and understand where are things going in the future, not just where are they today. Like, our human nature is to take a current line of thought and project it indefinitely into the future. Nothing is further from the truth. We live in a world of cycles. If you look back at each of these different recessions, this is a chart showing that one column in the previous one. You can see that typically recessions by nature are deflationary. Once the Fed gets in front of it, okay, that's sometimes a very painful process, and then rates come down. So you can see each of the different recessions that have taken place. When the Fed has then started to cut, they've cut because they've controlled inflation, they had to stimulate the economy, interest rates have dropped. So guys, we want to show this because what's most important here is looking at not just the run-up that we've had in real estate and the run-up that took place in 2004, 5, and 6 and saying they're the same, we're going to have a crash. No, we want to understand what's the same and what is different, okay? And what we're running into now, the pain point, clearly is affordability. But guys, here's the thing. Rents are increasing too. The key issue is a dramatic undersupply. It does not make any sense to have, this might even be one of the questions, but to have a lot of these hedge funds buying blocks of properties and buying inventory that have the best data in the world if there is a crash ahead. Like, people are looking for places to put money. There's more liquidity in this market than there's ever been, one of the reasons that we have inflation. But guys, we thought we would cover a lot of these things, and then as we start to wrap up and get to a little Q&A,
Yeah,
where are we now?
one of the questions we get asked all the time is kind of the crystal ball. What do we see? What do we forecast? And so this is a compilation of a couple of different entities that have given us forecasts for there. But I think it's important to note the 100-year average for appreciation for a home in the United States is around 4 to 5% annually. And so as Mike talked about with the rising interest rates and us starting to hit the affordability, it's actually slowed the housing market down enough to where we'll probably fall back to that line. So as you can kind of see the different forecasts all the way here, including Fannie Mae, Freddie Mac, the MBA, which is Mortgage Bankers Association, National Association of Realtors, and Zelman, you can kind of see the sort of average amongst all those is around a 6.1% appreciation year over year. And that's kind of what we're expecting to see in 2022. Certainly off of the highs of the 20, 25, 26% appreciation that we've seen over the last couple of years. So that's kind of what we're expecting. So, you know, there's a lot of emotions, a lot of questions. Mike, Kevin, you guys did an amazing job of helping us unpack information as we went through this. And like we said, nobody has the crystal ball, but it's great to go back and look at the underlying fundamentals of the market so that people can make their own healthy decisions about what's right for them. So guys, there's a chat on the right side of your screen. If you have any questions, we'll set some time aside here. We've already gotten a couple that we'll roll through, but one of the questions we get asked all the time, and it's certainly in our chat now, is when is the right time to buy a home? And Mike and Kevin and I, we've talked about that, but our opinion is the right time to buy a home is when it's right for you. And that's a very individualized decision, and we want to help them make healthy, factual decisions, not emotional decisions. And everybody's journey is a little bit different. Where you are in saving for a down payment, where you are in your housing needs, where you are in your income ladder, all of those things affect your individual journey. So we always say the right time is when it's the right time for you, taking into consideration all of those things. So another question we get, Mike, maybe you want to take this one, is I'm curious as to why a new buyer would care about anything but what's happening right now. And that was from our audience member, Jeff.
Yeah, and I don't think they would. I mean, people are going to serve what's in their best interest and look at it from an affordability standpoint. I think what we want people to know, there's a lot of folks that have a mindset that there's a likelihood of a big crash coming because there's been a big run up in real estate. And so all we want to do is look at the fundamentals and look at the facts and make a decision that's really based on longer term thinking. I mean, I would fully expect real estate to move sideways to slightly up for a window of time. A lot of appreciation's been built into the marketplace just with the low interest rates for so long and a thin inventory. So I guess the point, guys, is that those that are not able to buy or that are not wanting to buy, you have to look at the alternative. And traditionally, people are always going to, if there's a big enough disparity between the cost of ownership and the cost of renting, the majority of people are going to gravitate toward that lower quote cost, not factoring in that the cost of rents are typically trailing real estate by about 12 to 18 months to connect with the effective cost of home ownership. It's basic supply and demand at work. So great question. I don't know that they should, but what they should do is be aware of the differences between where we are today and where we were in the past.
Another great question. This might resonate with a lot of listeners, right? I'm not getting many warm, fuzzy feelings about being able to purchase a new home anytime soon. I'm making more than double what I was when I bought my current home. We've outgrown it, but I can't afford anything new because the prices of the homes are continuing to go, and I can't afford it. And it's outpacing my wage increases.
Yep, and guys, that's a pain point. There's no clear solution to the affordability issue in the short term. What I do expect is as the Fed gets in front of inflation, would not surprise me at all if sometime in the next 18 months we do see a dip in interest rates, mortgage rates, and then I also do know that wages are increasing, and I would also expect housing to move sideways. So it's a great point. It is the key pain point that a lot of folks have. But what you will see now is inventory, my opinion, inventory will start to rise and you will have a better opportunity to buy a house than has existed in the past. It's been a bit of a frenzy in the past, and that, quite frankly, has not been healthy for the housing market.
The other thing too that we're seeing a trend there, certainly this individual sounds like they already own a home, which is great because you've enjoyed the appreciation, significant appreciation over the years, is looking to expand where you are right now. You don't necessarily reset tax bases in some cases, and you can build in some affordability there. That's certainly a trend we're seeing as well. So the next one is kind of related to institutional buying or people buying Airbnb, but have an Airbnb or similar services impacted the supply, or are those not counted in the overall inventory?
Oh, it's a great question. So let's talk about both separately. The Airbnb, I do believe those are counted as individual investor purchases. And so last stat I saw, the investor purchase market had increased pretty significantly as a percentage. I want to say it was in the 16% of all purchases were investor related. A question we do get that I want to address is there's a perception that institutional buyers are just sort of taking over the planet, so to speak. Here's the reality, guys, that institutional buyers own about 800,000 single-family units, and there is 80 million SFRs in the nation, so it's 1%. The largest owner largest institutional owner is BlackRock through, I think it's their sister company, Invitation Homes, and they own about 300,000. Okay, so just to put it in context, it's just less than 1% of the total U.S. single-family marketplace is institutional buyers. And I think it's interesting because, I mean, you want to talk about having endless amounts of data. The fact that institutional buyers have a level of confidence, like I guess what you can't have is institutional buyers are concerned about inflation and know it's a hedge and are moving into the marketplace at a little bit of a greater rate. But I just think it's fascinating that the folks that have the highest level of intel and data are comfortable with residential real estate.
That's great. And the next question, I'm not seeing it on the screen there. Portion of loans which are 15-year fixed and portion of loans which are 30-year fixed now versus 2008.
Yeah, that's great. I don't know that I'm aware of the spread between the 30 and the 15. I would think it would be close to 80-20, 80% 30-year fixed, 20% 15-year fixed. I know that currently it's a roughly 1% adjustable rates. I know that is starting to increase because there's some breathing room on affordability with the adjustable rate, 5 and 7-year and 10-year fixed. Back prior, if you go to the 2005 and 6 years, there was, first of all, to Kevin's point earlier, there was an overwhelming majority. There was roughly 40% of all of the loans were not fixed, were adjustable. So we're talking about 99% fixed interest rates across the board, 30 and 15 versus roughly 60%. Big difference from a stability of buyer, stability and quality of credit standpoint.
Yeah, comparing the 15 and 30, both of them were fixed payments, right? So it didn't drive as much volatility as rates began to rise on that. Another great question is, interest rates dropped to zero during Powell's tenure. Will we ever get back to that again? How do we get out of this massive supply shortage and take steps to create affordability for the low to middle class buyers? Great question. Big picture question. That's a loaded question for sure.
So one of the challenges with affordability is I have a real good friend of mine's a COO for a nationwide builder, or West Coast builder, I should say. And in talking to him about some of these things, some of the fees that builders have to go through in order to get to build a home could run 20% of the total cost. So I know Pasadena, for example, if I'm remembering correctly, cost just to, before you have any cost of buying the dirt or building the home, you're looking at north of $100,000 of city-related fees to be able to get up and off the ground. So there's a lot of issues out there across the board, and everything's getting squeezed right now. So from an affordability standpoint, I mean, one of two things has to happen. Either prices have to go sideways long enough for wages to catch up, or interest rates have to come down in order to lighten up on affordability. There's no easy answers to that. That's the pain point. I think it's more a matter of that being a ceiling on growth for a while. And quite frankly, I do expect usually you have wages that are trailing. They're trailing typically as you have inflation that takes place. wage inflation is typically trailing to some degree. So we will see that start to catch up. I think it's a pain point for a while, though, to be frank.
And great questions. We have time for one or two more. This is another great question. We're starting to see this from a seller's perspective. What do we tell the owners of homes that are sitting on the market right now waiting for a buyer? There's a stagnancy of buyers right now. Do you think summer will liven that up? I guess the way I would answer that is the real estate market's regionalized. So it's kind of like saying, what's the temperature in the United States? It depends on where you are. So certain markets are going to see more volatility than others. But the numbers that we've shared are more of a national picture, a much broader scope. And kind of what we're seeing is the inventory is starting to normalize. Remember when we showed you that coming into the beginning of the year, inventory in some cases was less than 1 month's supply, and in some markets maybe as much as 2 months, when a healthy normal market is 4 to 6 months of supply. And we are just now starting to creep over 2 in most markets, maybe 3 or 4 months in some, to where it becomes more normalized. So what you see is when people were listing homes, they would typically look at the last closed sale, and the realtor would meet with them, and they would list just above that. Because the demand was so high, it would often close even higher than that. And so people kept chasing the listing price up. What we're seeing in most markets now is the listing prices are starting to reflect the market now, and it's starting to correct the listing prices. But big difference in listing price versus value of the home. So we still think in most markets, the values of the home are going to continue to inch up 4 to 6%. Again, regionalized depending on where you are and based on your inventory. So great question, Mike. Anything you would add to that?
You know, I'll actually answer that and address the question. There's one, my daughter's 27, single, would like to buy a small first home. What should her first steps be to see what she can afford? I thought that'd be a good one for Kevin.
Sure. Yeah, absolutely. Great question. So the first steps to see what she can afford and what she should do is likely have a conversation with a home loan specialist here at Churchill about her specific situation. What we would talk about is, hey, what does your income look like now and projected moving forward? What's the alternative in terms of renting? What does your timeline look like? What can you afford? Not just what you can qualify for, but you know your lifestyle better than we do, right? So you can oftentimes tell us where you're really comfortable, where that payment needs to land. And then, a great first step at that point is if you're ready to take the next step, we have what's called our Home Buyer Edge program here at Churchill, where we can fully underwrite you up front so that when you find a property, you can close very quickly and without stress. You can be really competitive in this market. And maybe more relevant right now, with rising interest rates pretty consistently over this year, we can secure your interest rate for 90 days while you shop as a maximum. So if rates go down, you get the better rate. If rates go up, you have a predictable payment that you're shopping on, and your payment doesn't have to change consistently. So that would be a great first step, I think, is talk to someone who can help give you the perspective of here's where we think the market's going, here's what your alternatives look like, lay out the numbers for you, and really just help you make a good, confident decision. And quite frankly, if it's not the right time, here at Churchill, we'll be the first ones to tell you and advise you of what to do next, to either save or work on other areas of your finances. So I think that would be a great first step.
Kevin, kind of another interrelated question to that is first-time home buyer. Any suggestions we have for getting them ready? They're looking at the market and simply can't afford the current payments with the interest rate and the house prices. What suggestions would you have for them as they continue to look?
Good question. I think it's different for every buyer's situation of whether there's an alternative to put more money down or potentially save up more. But if you're in the market and just need stability, I think that Rate Secure program that we offer is really a great tool because a lot of people right now out there are shopping for the last 60 days and their interest rate is 2% higher than it was 60 days ago, and that takes them completely out of the market or into different properties. So if we can at least give you predictability, here's what your payment's going to be, watching what prices do, being aggressive with our offers with the certified home buyer, that would be a great tip and a tool, I think, to look more into here with Churchill.
I think, too, one of the things we look at, too, is what the cost of waiting potentially could be so people can quantify whether it's better for them to wait and save more or whether they should take action now, too. Just thinking of a soundbite from our friend Dave Ramsey over at Ramsey Solutions recently that we heard, too, where Dave is saying that the best time to buy a house is now over the next 5 years. So everybody's situation is different. That's where it comes to a very unique, individualized consultation to make sure that we help you make a healthy, safe financial decision for you and your family. So next question, doesn't consumer confidence have a lot to do with consumers' participation in the market? It seems that as we as consumers lose confidence, we stop buying, which severely impacts the market. Mike, you talked a lot about that and the emotions and fears at the beginning of our presentation. I'll let you take that one.
So guys, there's a couple, in my mind, I think of it this way. There's fundamentals that are going to drive the majority, let's just call it 80% of the outcome, and then there's fear or greed that will drive a certain percentage. And I don't know if that's 1% or 20%, but it certainly has an impact. But the reality is that the markets always catch up to themselves over time, sort of like water seeks the lowest level. So greed or fear will temporarily hold something or push it forward ahead of itself. I think we're seeing right now, some of, to Rick's point earlier, we're seeing on the listing side, there's a lot of, quote, reductions in listing prices. But a lot of those listing prices were, last sale was here and we're going here because we think we can get it and it's going to sell here. So we're seeing things normalize. And at the end of the day here, there is just such a lack of inventory. I mean, when it comes to the folks that are being moved out of the office or moved out of the market from affordability standpoint, and then also the folks that are scared, at some point things get to a price point where people are comfortable or affordability. Now, we got to keep in mind those that are buying, roughly, I think it's 27% of the marketplace is cash buyers. And then you have another, let's call it roughly 50% of the marketplace that has no affordability issue. They're not happy about interest rates increasing. But then you've got the first-time buyer, which is, I think, roughly 30%, where maybe a third of them to half of them are running into pretty significant affordability issues. So the other thing we've got is we've got some landlocked issues where folks that would normally move up or move down, they're sitting on a high 2%, low 3% interest rate, and it doesn't make sense for them to move up because they think of, well, I can build an addition for much cheaper rather than make the move. So there's a lot of dynamics happening that are actually exacerbating the issue from an inventory standpoint. But yeah, that's a great question.
Yeah, it seems like there's a lot of shock and awe, right? And whenever the market moves really quickly, there's a little bit of shock and awe that takes place where people are like, oh my gosh, and then they get back and the underlying fundamentals take place, and then they come back and make decisions. And we've talked about rents have risen far greater than the mortgage payments in most markets as well. So once the shock and awe is over, then the normalcy sort of kicks back in, and that's where you need the facts and not the feelings. So a couple of great questions in there related to underwriting and credit. What about buying as a self-employed? Are there ways around a 2-year income verification? Kevin, you want to talk about that? I know there's lots of programs out there where it's alternative to what the normal documentation would be.
Yeah, it's a great question. And there are alternatives around standard documentation. Typically, a 2-year income verification would get you into like a conventional type loan. There are different products out there where we can use the revenue your business generates as income instead of the net profit or a lot of times the equity in the property or the assets in the bank. So a little bit specific depending on your circumstances, but I would definitely reach out to a home loan specialist at Churchill. There are ways around standard income verification depending on what you're looking to accomplish and some of the other factors involved with either your business, your revenue, or the house and the mortgage itself.
I think it's important to note too, I know people get nervous when we talk about alternative documentation because bad lending practices or lacked a little bit of responsibility that drove us into the last crash. The Dodd-Frank bill passed post that great housing crisis now requires lenders for primary residences to document, they call it the ATR rule, the ability to repay the loan. So when we get into alternative documentation around self-employed, it's a common sense approach. It's not a stated income. We look at other ways to validate the income that you would make. So that's a big difference between then and now as well. So does Churchill do manual underwriting? Kevin, I'm going to leave that one over to you, Ken, too.
No problem. Yes, we at Churchill do manual underwriting. And what that means essentially, if you're at home wondering, is that if you've paid off all your debt and don't have any revolving debts currently or anything you're paying off, oftentimes your credit score will disappear. And credit score is a huge portion of what we're underwriting to from a loan perspective. What manual underwriting is where we essentially build a new credit report out of other things that you pay for, your rent, your utilities, your cell phone, your insurance payments. We can create a credit report essentially and still be able to have you qualify for a mortgage. There's slightly different requirements in terms of down payment, some of the history of those, some of your income history. So it's a little bit case by case of how to prepare for that. But if you do not have a credit score, does not mean that it's impossible to get a loan. You just need to do a little more preparing ahead of time. So I wouldn't hesitate, even if you're a year or two away and want to start to prepare the right way, to make sure that when you are ready, that you know all the details that go into that. But that is something we do here at Churchill. And yeah.
Last question here, guys. Isn't it still cheaper to rent than buying with interest rates being so high? Low affordability, low inventory that we have now. Great question.
It is a great question, and I think the answer is that's going to be regional, but in many cases it is. But we don't want to just think about today, we want to think about tomorrow. And what we know over time is that real estate grows, the mortgage payment stays fixed, and rents increase over time. I think that's something that's lost on a lot of people, is that rents increase. And usually when we do an analysis on this, we have a rent versus own analysis that we'll do, and ask your loan officer, I'm sure they have access to this as well, is we'll look at where rents are and the cost of ownership, but then we'll look at a realistic increase of rents that would take place based on some conservative projections to be able to see a net worth difference over time. Because we don't want to just look at cash flow. Cash flow is important. We absolutely want to look at cash flow, but we don't want to ignore a 4 or 5% appreciation in real estate over time. We don't want to ignore equity being built in a house by paying down a mortgage, and we don't want to forget about the fact that rents are likely going to increase. My personal opinion, they're going to increase, and it's going to be fairly steep over the next few years, because usually it trails the cost of real estate by 12 to 18 months. So the answer is yes. It most likely is cheaper to rent right now with interest rates so high and with the affordability issue. But over time, the ownership compared to the rental comparison side by side over any meaningful window of time, 99% of the time, there's an overwhelming argument on the side of ownership if somebody is able to afford a home and buy. So fantastic question. That, my personal opinion, is that what is deeply important to us and to Churchill is not just to provide a loan and tell somebody if they can be qualified, but to give them guidance and strategy and advice. Should they buy a home? And if so, why should they buy a home? I think that's something that's fundamental to who we are and why we do what we do. But fantastic question.
Well, guys, it was really fun to talk through this. Hopefully we helped out there shed some light on the fundamentals, the math behind things, to help answer some of the emotion in the marketplace and help people wherever they are at in their journey make a healthy financial decision. If you want a deeper consultation, please let us know in the survey. If somebody invited you to them, you certainly can reach back out to them specifically. Mike, you said it best, guidance. We're here to help answer questions so that ultimately people have the information they need to make a safe, healthy financial decision. And we're so grateful to get to spend some time with you today. Hopefully it's helpful. Look for that survey. We'd love the feedback, and be well. Mike, Kevin, thanks.
Thank you.
Thanks, guys. Take care.